Hello, happy Thursday, and welcome to VITA Off-Season Prep 2022 Tax Law Updates. You are definitely in for a great webinar today. We have some amazing people on the line that are here to give you as much information as possible to make the upcoming tax season seamless. But in the meantime, we will give people about a minute more to join the platform, and then we'll get things started. But thank you again for joining us. Okay, so I see the room is filling up, so I'll get things started. Again, thank you so much for joining us for VITA Off-Season Prep 2022 Tax Law Updates. You're in for a really good webinar, but just to kick us off, I'm going to start us with a few housekeeping tips. So just a reminder, you're muted right now because this webinar will be recorded and made available within a week from today for you to reference as you take on the upcoming tax season. And then also, we want you to ask questions and share your thoughts. Please use the questions panel as opposed to the chat to interact with the panelists and the moderator for today's webinar. Leave us any questions, comments. We will have a Q&A section that we really want to be robust and as helpful as possible. So definitely tune in for that and submit your questions. And if you are experiencing any technical difficulties, please email us at gotomeeting@prosperitynow.org. We want you to get the most out of today's meeting. We know for most of us, it's starting to get a little chilly outside, so please join from a quiet place and grab something warm to drink, whether it be a hot cocoa or a coffee or a snack. We really want you to get comfortable and settle in to take in everything that we have here for you today. Also, engage with us. Again, please use the questions panel as opposed to the chat to submit questions. Ask us anything that comes to mind so that we can be as helpful as possible. And reflect on ways to apply what you learned today. Here at Prosperity Now, we try to ensure that all of our learning opportunities come with as many tips that are applicable as possible. So please reflect on ways that you can apply this to your work. But without further ado, I will pass you along to our program manager for ecosystems change here at Prosperity Now, Justin Chu.
Thank you so much, Olivia. I know that the team name is a mouthful, but I want to thank everyone for joining for today's conversation. It is a great time to get ready for VITA and a great time to learn about all the new tax law changes that we've experienced over the past 6 to 8 months. We've got a lot in store for us. We are seeing that there is some audio technical issues. If you're having any audio issues, obviously, please do refresh the platform and come back in. If you have those at any time, we would highly recommend that. On the next slide, we're going to do a little bit of an icebreaker before we kick it over to our wonderful presenters. And for today's chat icebreaker, we're just curious how many years of VITA experience you have. So we're going to open up this poll. You can select one of the following 5 options: less than 1 year, 1 to 2 years, 3 to 5 years, 5 years or more, or 10 years or more. So we got a lot of different options. So feel free to select a response, and then we'll close it and share it out with everyone to find a little bit more about how long everyone's been involved in the VITA program. All right, it looks like we've got a good spread of folks here today. We got some VITA long-timers. I would myself be involved in that 5 years or more, but it's always great to see new faces. For the 1 to 2 years or less than 1 year, We're really excited to have you on board. Hopefully, we can get you into that 5 years or more category of VITA experience. And I know our presenters here today would definitely fall into the latter two categories. And with that, I'm going to kick it over to our presenters, Brad Martin from the United Way of Southwest Alabama and Marshall Hunt with the Accounting Aid Society in Detroit.
Good afternoon, everyone. This is Brad. Thank you, Justin. I appreciate the opportunity to present today, and I hope that I'll be sharing some information with you. You can, what we used to say in radio is news you can use, right? We're here to talk about the changes that have occurred in the tax law for the next year, and I've seen worse in terms of the drastic scope. And for those of you who are in that 5-year or more category, you'll feel like a lot of this is familiar because what I noticed is that a lot of this goes back to the way things were either in 2020 or perhaps in 2019. So without further delay, I will go ahead and start. We're going to start with changes to forms, and I want to explain, and this is not in the slideshow, so to my moderators, Olivia and Justin, don't panic if you don't see what I'm about to say. I thought of this at 2:30 this morning, and I realized it would be helpful to have a brief discussion. So we're going to talk about forms, and I wonder if people realize, and I'm sure some of you do and some of you don't, but if you, when you think about e-filing a tax return, if you envision that when you hit that transmit button, what happens is that it sends the IRS a beautiful 1040 and a beautiful printout, just like what you send to your clients. Please remove that notion from your mind. That's not how it works at all. And as we go through this, you'll understand why I want to explain this. So what happens, and this is not, from a technical perspective, probably not 100% correct, but from an analogy perspective, it's understandable. So if you think about an Excel spreadsheet, which most of us have used, with lots of columns, and there are columns in this Excel spreadsheet like first name, last name, address 1, address 2, city, state, zip, social, birthday, it goes on and on, wages, interest, dividends, the whole 9 yards. Imagine that spreadsheet. Now imagine that when you send a return, what you send is a list of fields and their values. First name equals Brad. Last name equals Martin. Address 1 equals 218 St. Francis Street, which is my office address. And it goes on from there. And it's fine if you've ever imported records into a database. You know that it works great as long as the fields or the columns in the database or the spreadsheet match the columns that you're importing from whatever that source is. So as long as the database says first name and the thing you're pulling information in from says first name, no problem. But if the database says first and your information says first name, that doesn't match. Or if the database says gambling and what you're pulling from says lottery because you wrote in lottery instead of gambling, not a match. Now we have a problem, and it throws the whole thing into somebody's got to look at it. I say all of that to say what we're going to talk about in the next few minutes is a lot of forms changes that were made to decrease the number of those variables. In other words, instead of maybe you wrote gambling and I wrote lottery, now there's a gambling line, which there was last year, but there are some more of those this year. And that's why you started seeing it last year. You're seeing more of it this year. These lines that are like 1A, 1B, 1C, 1D, and they're all these different line entries. That's why we're doing it. Yes, it makes the forms longer. Yes, it means there's more on the page. But it's really to allow for better automated processing of the returns, which means faster processing of the returns. And I think we all learned with COVID that when hands have to get involved, all kinds of things happen. So that explanation aside, I will move to the first item up for bids on The Price is Right. So the first thing I want to point out is that there's a new digital asset statement. We're not calling it virtual currency anymore. We're calling it digital assets, right? Because I don't know a lot about crypto, and as you know, most of that stuff is out of scope for us anyway. If they have it, but they didn't do anything with it, then it's not an issue. Although I will say, those of you who are involved with AARP Foundation Tax Aid, they have decided nothing to do with virtual currency is in scope. So if you have it, not happening today. So be aware of that. But we've changed the name now to digital assets, and there's a statement you can probably see on the screen, which it at any time during 2022 did you, and it asks if you received or sold any kind of digital or had an digital assets or an interest in digital assets. Okay, so that's just when they say digital assets, they're talking about virtual currency, crypto, the like. Okay. Moving to the 1040, and this gets into what I was just talking about. So line 1 has, ever since 2018 when we moved to the new format, line 1 has been where all your earned income credit, all your earned income lands except for things like your Schedule C. So in other words, all your wages, your household employee, your scholarships on a W-2, all that stuff used to land on line 1. Now we've got separate breakouts for all these different entries. And keep in mind, you're not going to do anything different in the software. These things were always there. It's just that now they're spread out on the form and explicitly defined so that we don't have to write in SCH for scholarship and that kind of thing. So line 1 has turned into about 10 lines. We've got one for our amounts from forms W-2. We have household employee income that's not on a W-2. Tip income that's not reported on 1A. Medicaid waiver payments that are not on a W-2. Taxable dependent care benefits. You can see these here. Employer provided adoption benefits. Wages from Form 8919, that has to do with wages where Social Security and Medicare taxes were not collected. And then other earned income is going to be, I think, a work in progress. And one thing Marshall and I had gotten into a discussion about with trying to figure out how they were going to handle things like strike benefits. Marshall, do you want to talk about that a little bit? Because you have more experience with that than I do. And they said it was going to go to 1H and be calculated as earned income, right?
Yeah, sure, Brad. A couple of years ago, one of the automakers had a strike. And when I researched how to handle the benefits, I found that they're listed as earned income for the earned income tax credit, but there's nowhere in the instructions telling taxpayers how to report them and get the earned income tax credit. Some softwares would take it into other income, things like that. We raised that with IRS. I don't believe a lot happened at that time, but now with the new form changes and ton getting involved, Taxpayer Opportunity Network got involved, and IRS said they will put instructions, put strike benefits into the instructions. So I think we've had a success there through advocacy with TON.
I agree. And so what they've said is that basically you would put it on this 1H line for other earned income, and that it would then be calculated for purposes of the earned income credit. Right now, I don't quite see, we haven't seen exactly how that's going to work in software, because what you have to watch out for is that when I tried to sort of wedge it in, it tried to charge me self-employment tax, and that's not correct. So, but again, these are fluid changes, and we're waiting to see how this is going to play out.
Brad,
Yeah.
add one thing here, Marshall. There is a workaround in the 4012, but I tried it and I don't think it is still ready for prime time. But there is a workaround. Whether that will change when the form instruction change, we'll just have to wait and see.
Right. And I haven't looked at that, so we will. But we'll, as I say, we know that software is a work in progress, no matter what software you use, and so as these things change, we'll catch up. But thank you for that discussion, because I know you've seen that and I have not. Notice they've moved the non-taxable combat pay election up to line 1 because it ties into the earned income credit. It used to be on like line 27B or C, something like that. So keep that in mind. And then 1Z is just the compilation of all those one lines, right? So now that's going to be sort of the summation. So that is what has happened there. And like I said, we've always had the ability to enter these items. It's just a matter of where they're carried to. The next thing I want to talk about on the next slide, we have on page 10, on Form 1040, line 6C. This is another example of avoiding a write-in, which I am very grateful for, and I'll give you an example. Okay, so if you have ever done a return for somebody where they received their disability back pay and it covered, say, 3 years, you can elect, if you have the prior year's return, to do a lump sum benefits worksheet, and it really can be very helpful. It does not help in terms of calculating the premium tax credit income calculation, but it's wonderful for a lot of people who otherwise would get hit with a huge taxable Social Security income. And so this is where, instead of having LSE written in on the return, there's a checkbox, which means, going back to my analogy of the big spreadsheet with the fields, now you can have LSE equals true or LSE equals false. That may not be how they word it, but that's the idea. And so a computer can process that, right? LSE equals either true or false. True, yes. False, no. Good, we can move on. So that is an improvement, because I had a client last year, I did an LSE for a lump sum election, and she got her refund and it was reduced, and basically whoever was dealing with that missed the lump sum election and calculated the whole amount as current year income. So I'm glad that a computer now can pick up that checkbox. So this is a good thing. Next slide, let's see. Schedule 1. Line 8 already had up through 8Q, I believe, which would be 17 lines. And we've added R, S, T, and U, and these are the items listed here. So scholarships and fellowships that are not reported on a W-2, non-taxable amount of Medicaid waiver payments included on the 1040, pension or annuity from a non-qualified plan or a non-governmental 457, and certain wages from penal institutions. So wages earned while someone is incarcerated. So those are going to have their own separate lines, again, just to eliminate those write-ins and let the computers deal with it. Schedule 2. Okay, if some folks, 5329 is the form that you complete when, particularly for people who have early withdrawal. It has a bunch of stuff on it, but the only thing we usually use it for is early withdrawal penalties for retirement, IRAs, 401ks, etc. And in certain instances, they don't require you to file Form 5329. This tells the computer you're not required to file Form 5329. Software is going to take care of that. So just be aware that's a new addition. So now the hot potato, we're going to move to the idea of these 1099Ks. This became a huge topic, and I will give you some basic information. I'm still trying to clarify a few points. I am going to write an article about this once I have everything clarified, that to my satisfaction, or to the ability that I'm able to get it clarified. I think there's going to be a murky road this year. But I will explain the background here, and I will tell you what I have been able to figure out thus far. I spent all day Monday on this topic, literally all day Monday. So we're not going to go down that rabbit hole too far. But here's the deal. Form 1099K is sent out by third-party networks and payment processors. If you have ever done a GoFundMe and they ask you to choose whether you're going to pay, deal with either WePay or PayPal, those are payment processors. If you have Venmo, if you have Cash App, these are payment processors. They handle payments from other people to you. And in the past, the rule was, in order to be required to furnish a 1099-K to you and to the IRS, there had to be $20,000 of payments received in a year and more than 200 transactions. Now, this year, those rules have changed, and the number of transactions is irrelevant, so that 200 is out the window. But if you have received more than $600 in payments from a processor for goods and services, then they are required to furnish you a 1099-K, and that is also furnished to the IRS. Now, I have looked into at least Venmo and Cash App to see how they're going to handle this, because we use Venmo at work all the time. I'm not going to lie to you. We do that all the time because somebody buys lunch and then the rest of us pay them back. And then the next week they send us our money back when they buy lunch, or when we buy lunch for them. So it's really just passing money back and forth, and I feel a little silly doing it, but we do it all the time. Cash App is very clear how they plan to handle this, at least on paper. So they want you, if you're doing something that is for a business, they want you to get Cash App for Business, and it's a separate account. The Venmo is pushing you in that direction as well, but if you have a personal account, you can end up paying business fees with a personal account. They don't want you to. They want to break it out. But I had a friend who did something. She was reimbursing me for something. I don't know what she did. They took a fee out of it when she sent me her payment. And if it were more than $600, I feel quite certain it would have triggered a 1099-K. So what we're not real sure about is how to handle payments that we receive, or that the client receives, that are not really business payments. They're not for goods and services, but somehow they got goofed up. The best we've been able to get thus far is that you should, and I'm just going to say it, don't laugh, that you should, there will be a phone number on those 1099-Ks, and they're saying you should call to get it corrected. This is Brad talking for the next 10 seconds and nobody else. Do I think that I'm going to be able to call Venmo and say, hey, there's money on my 1099-K that shouldn't be there. Could you just take it off? No, I don't. I will be really surprised if they're like, yeah. I won't be surprised if they're like, yeah, everybody says that. Sure, whatever you say. Yeah, right. So, but that is the first instruction. And then if you decide to leave it off the return, which is going to lead to some pretty tricky consequences, because you know it's going to get looked at, include an explanation of what it is, and be prepared to back it up, because they could very well come back and ask you, because again, anyone would love to say, oh, this money really isn't for business. It really isn't, income as such. It's a gift. It's a donation. It's a whatever it is. And so you're going to have to be able to back that up. There was some talk of whether that would require a paper return. I think, based on what I've read from TaxSlayer's help articles, that using the preparer notes section could be used for that. I haven't actually had someone explicitly say that. I know there have been discussions of other workarounds. I have seen them other places as well. I am skeptical that some of them will work in terms of the technical behind-the-scenes way that stuff is handled. So I'm not going to go down that rabbit hole right now. I'm going to try to get more specifics about what happens when you do some of those things. And of course, I'm going to write an article about all this for the Tax Prep Dispatch, because I think it's going to be an issue. I think if we leave the income off, it's going to lead to communications with the IRS and could definitely slow down the person getting their refund. If you leave it on, then you're charging them tax on income that shouldn't be taxed. And another instance where this could come up you had a garage sale and you clean out, maybe you had an estate sale, your parents passed away, and you sold all your old board games that were 30 years old for, half what you paid for them, if that. And you did it on eBay. Well, now eBay is going to have PayPal or whoever handles their processing these days. I haven't done eBay in forever. Send you one of these forms, because to them it looks like you have had business income, but it's all at a loss because it was just personal property that you sold online. And so there's a lot of murkiness about this. And that's why I want to do a little more research. I want to try and organize it. And then I want to be able to present it in a way that hopefully will be solid, useful for you as you run into this. I don't think we're going to see as much of it as we're afraid we are, but I think when we see it, we're going to be kind of awkward about how to handle it. So I do want to look into it a little more before I tell you what I think is going to happen or how we should do it. What I've told you is about as much as we've been able to get thus far. And I'll share more on that as we get there. Okay. I'm moving on. Okay, so the next slide we're talking about, these are forms that this is Form W4P, which is now being split. And these are not forms that you would use to enter the information into the tax return. These are forms, if you're working with a client, because we all know we help people with more than just filing those tax returns. If they are asking you, I'm about to take money out of my IRA, and I want to know how I can have them take taxes out. Form W4P was how we always did that with retirement. Now you've got two forms. W4P is for periodic payments. So if you're getting a monthly pension and you want them to hold 10% out, you would use the form W4P to fill that, to make that request. If you are dealing with an IRA and maybe you have to take a minimum distribution and you want to advise your account holder how you want that tax held out, that's going to now be on a W4R. Okay, so it's just two different forms for the different roles. One is for periodic payments and one is for non-periodic payments and eligible rollovers. And that should take care of the forms. And so now I'm going to turn it over to Marshall to talk about some of the tax law changes, and then I'll be back with you in a minute to talk credits.
Brad, this is Marshall. Did you want to comment on on the horizon?
Oh, thank you. I missed that. I scrolled right past it. That's what happens when you're just having your computer talk to you while you're talking out loud. The last thing is on the horizon. So in 2023, there's going to be a new form because we don't have enough forms, right? But I'm actually kind of excited about this. If we're going to have to at some point deal with virtual currency. Right now it's out of scope, so don't panic. 1099-DA is the new form, and it's going to be basically a digital assets version of, sounds like it's going to be kind of like a 1099-B, like you would get for stocks, but for digital assets. And so I hope that means there will be better reporting of such things. I'm maybe a little optimistic in that regard, but and that it will be easier to help people and we won't have to turn them away. But in any case, that's the 1099-DA, and that's coming in 2023. So nothing you're going to see this year, but if you run into clients who are doing virtual or digital assets, you can let them know that in future years this kind of thing is going to be coming, and because right now it's kind of the wild, wild west of reporting of those things from what I've seen. So I apologize. Now I'm officially through with forms.
Well, thank you, Brad. This is Marshall. I'm going to talk about some other changes. Some of the income limit changes discussed in the publication 4491 are above the recommended VITA limit of $60,000. Again, that's a recommendation, not hard and fast. So I'm not covering some of those limits. Also, I'm not going to cover tax bracket changes. I'm throwing enough numbers at you a little later in the presentation. I've had over 40 years in VITA, and it's been a fantastic experience. I'm hoping the next 40 don't go as fast. It would take a medical miracle for me to get 40 more, but I'm hoping for whatever I can get. Recovery rebate credit, that's gone. I think the thing to remember on all of these changes that you still have a federal refund statute of 3 years. You can go back and get some of these. The child dependent care credit, several big changes here. I'm focusing on the changes. I may bring in a couple tidbits about the credit itself, but it's gone back to a non-refundable credit. Our biggest challenge this year on this, child tax credit, earned income tax credit, I think are going to be explaining to the taxpayers why their refunds are so much lower this year. We're just going to have to do our best there. Basically on this one, the reduction in the credit percentage itself now starts at 15,000 instead of 125,000. Small change there. Expense amounts are down now from 8,000 and 16,000 for 2 or more qualifying children to 3 and 6. So that's a big change there. And then the percentage has gone back from 20 to 35% instead of 50%. I see we have I believe about 11% of attendees that are fairly new to VITA. Good news for you, you don't have to remember what happened in 2001. You can focus on the 2002 law. Again, it's a credit for allow people to work or look for work. It's for the care of a qualifying child under 13, a spouse who is incapable of self-care, or a dependent, or somebody who would otherwise be your dependent, but for 3 of the dependency tests, who is incapable of self-care. You can pay a relative, that can count for the credit, but they can't be your dependent, can't be your child under 19, or a spouse or a parent of a qualifying child under 13. The key is, though, you can pay a relative. What my experience at the site is, 1, remember it's now non-refundable. So watch the standard deduction limits. Nothing worse than telling the taxpayer to go back home and get the provider's ID number, which they probably can't get in some cases, except for a daycare center, and then come back and then realize it's a non-refundable credit and they don't owe tax. So just kind of watch those limits. That's my recommendation. And the other problem is getting the number. Now, when they tell me that they're paying their mom or their sister who are not dependents, once I ask for that ID number, that sometimes ends the conversation. They don't want to tax their relatives on this, but sometimes, it's definitely a credit to consider. A buddy of mine, a couple of years ago, who always asked me tax questions, realized this credit was there. He was paying young people in the neighborhood to take care of his kids after school. And I told him, yeah, you can get the credit, but you've got to get their social security numbers. Well, he started doing that and quickly found out that it's better to forego the credit than incur the wrath of all the parents who didn't want to give their kids social security numbers. If the taxpayer can't actually get the ID number from the preparer, then there are procedures. They should use due diligence, use a W-10 to get the information, and go to page 10 of publication 503. That tells you what you can do. It'll require a paper return, but that's the way it is. The private mortgage insurance premiums deduction, that's out. That expired a couple of years ago, but was retroactively reinstated. I don't expect a call from the governor on this one, but who knows? I think right now the biggest issue in play for individuals is the child tax credit. That may be changed in exchange for some business benefits. We'll see what happens. The charitable contributions, that's out, the extra deduction beyond the standard. And then the 133% for the premium tax credit calculation is gone. There was some email traffic on that a little earlier regarding IRS notices. I didn't keep up with that, so I'm not sure where that ended up. And then finally, the provision for qualified sick and family leave credits for self-employed expired on September 30th, 2021. It would be self-employed that would benefit from that with our programs. Okay, next slide. And on any of these, we'll take questions at the end as needed. The exclusion from gross income for student loan forgiveness, that's been extended, that goes until 2025 or before 2026 for most forgiven student loans. There won't be 1099-Cs issue, or shouldn't be, on this one. That may cause some problems for the states who have tax credits based on non-taxable income, but the preparers in those states are pretty good at asking all kinds of questions about all of the possible income a taxpayer could have. A quick aside, I first met Brad a couple of years ago, a Michigan taxpayer who had no taxable income but filed for Michigan homestead property tax credits, moved to Alabama. She couldn't understand why Brad's site couldn't get her the same refund she got in Michigan. Well, a couple of calls with Brad, we each learned a little bit about each state's taxes, and with a multi-state effort, we got her a final Michigan property tax credit. And then she had no need to visit Brad's sites in the future unless she came up with some taxable type income. The food and beverage deduction, and I've italicized the word from in this. Now, I work at a small site, very low income. Most of the taxpayers there are filing with ITINs. They're paid in cash and are drywallers, cooks, landscapers, things like that, self-employed, but they don't have typically enough money to buy lunch for themselves, let entertain a business customer or a business associate or employee. The key here is this: you have to meet 162. It has to be ordinary, necessary, and reasonable for you to take this person to lunch or dinner. It's for meals. Entertainment is out, but you can still get 100% deduction for a meal from a restaurant. We could probably spend an hour discussing what is or isn't a restaurant. And if I go too quickly, we might have to. But if I take my best customer over to Taco, well, I was going to not name a restaurant, but let's say I take them to Taco Bell or, be fair, McDonald's. We can either eat there or take it out and eat in the car or bring it back to the office. That counts as from the restaurant. If I take them to the mini mart where food is available on shelves and grab a couple sandwiches off the shelf, that doesn't count. Now I can still get the 50% deduction for those meals. How much this affects VITA, I'm not sure. I just don't know if we see a lot of that with our VITA clients, but just realize it's not for your own meal unless you're in travel status. But once you're taking out a business associate or buying their lunch with you there, you can deduct 100% of both meals. Taxes and tips count in there. Transportation is separate, but if you're getting 100% on the meal, that would be 100% also. Okay, that's pretty much it. Entertainment is no longer deductible, but if you buy food from a restaurant at the entertainment venue and it's separately stated, that counts for 100%. Okay, let's look at the 5250. This is the contribution of $5,250 towards an employee's student loans. That's in there, and also other expenses, tuition, fees, books provided by the employer. This provision was originally set up to pay for bachelor degrees, because a master's degree, if it's related to the employer's business or improves or maintains the skills of the employee, that can still be paid for tax-free by the employer as a working benefit, working condition benefit fringe. We'll talk more about that in just a minute. But now this can apply for bachelor's or graduate school work. On the working condition benefit, I wanted to mention that that's the deal there is that if the employee could deduct it, if they paid it themselves, then the employer can pay it and tax-free to the employee. So if the employer decides to pay a graduate level course to maintain or improve the employee's skills, then that can be paid tax-free. Question came up, of course, now that employees actually can't deduct these anymore as a miscellaneous itemized deduction, can the employer still pay it tax-free? Well, publication 15B states they can. So still be allowed as a working condition fringe. The 5250 though kind of provides the employer a safe harbor. They can pay this without having to worry about whether this meets the skills, maintaining skills for a graduate level course. The exclusion from gross income of canceled qualified principal residence still is with us through 2025. And then the 400% of federal poverty level, that limit is gone until 2025. Anybody now with household income of 100% more may be eligible. It might be harder to get eligible at those higher poverty level numbers, but it is available. Finally, on this slide, the non-business energy credit is extended for 2022. Name has been changed to the energy efficient home improvement credit, but unfortunately, or fortunately, is still subject to the combined credit of $500, $200 windows for all years after 2005. I'm not sure the IRS tracks this one. You know, when the home buyer's credit came in back in 2008 with a 15-year payback, even though I worked at IRS for 34 years, I said, well, wait a minute, IRS is not equipped to track this. Well, I was wrong. They have tracked it. I'm aware of one case where the energy credit was questioned by the IRS, but they didn't raise the lifetime limit, although they didn't have to because the credit was improperly claimed to begin with. There are changes for next year. It'll still be non-refundable, and that's the key. This is non-refundable, so again, it doesn't help a lot of all the taxpayers we serve. But the limits have increased. One thing to keep in mind, roofs are no longer covered in 2023, and air circulating fans are no longer covered. There are higher limits involved. If you've been thinking about that new roof, you got a couple weeks yet to do it. Okay, next slide. ITINs. Even though I've retired from full-time work at Accounting Aid Society, I've stayed on part-time as a certifying acceptance agent. I really enjoy the work. I really like to get people into the tax system. Now, there's always risk, so I always have to point out the pluses and minuses, but I think it's a positive to get in the system. Any of the numbers signed before 2013 should have expired and should have been renewed. Now, this year, I still had people coming in that had not renewed, and when their returns were filed, And you can e-file a return with an expired ITIN. It's just that once it goes in, the IRS will disallow all the good credits, and then send the taxpayer a bill, which you have to straighten out. But that can be straightened out by getting a renewal on the ITIN. Quick caution: some notices for ITINs beginning in 2013 indicated a 5-year expiration. That rule was rescinded. The IRS quickly realized that was not practical to start renewing every 5 years. So they just dropped the requirement, but unfortunately didn't change the notices. So you might see that, but they are valid if issued beginning in 2013. The other thing, though, that will cause a revocation of the ITIN is if it's not shown on a tax return in 3 consecutive years. So you do have to watch that. That's sometimes the issue. Some ITINs are issued only for information reporting. Those are not subject to that 3-year rule. Big change that came in last year is that now to renew an ITIN, you must submit a tax return if it's a number that's going to be on a tax return. So you either have to do it with an original return, which happens when they walk in during season, or if the renewal becomes known, that's when they get the IRS notice disallowing credits, then you have to submit a copy of the return. It all can be done. Right now, it used to take, right now it's taken me about 13 weeks even to get a renewal approved. Before COVID, I was getting them done in 3 weeks. That makes a big change on how you submit them. And I've covered that just below. In the 8812 instructions, it states that if you apply for an ITIN before the due date, including extensions, and the IRS issues an ITIN, then it will count as timely. Now, for the child tax credit, other dependent credit, American Opportunity Credit, the ITINs have to be issued before the due date, including extensions, to get the credit. So you have to be careful. I've started using certified mail for all of my ITIN applications now, which I didn't really have to do back in the day when they were coming back routinely so fast. Question comes up, well, how do you file an extension if you don't have a number? And that was always a question I had, but fortunately, publication 1915 tells us what to do. You write ITIN to be requested on the 4868 extension. I did some of these this year because the child tax credit was so valuable for 2021. I decided I really needed to make sure these got in. So I filed extensions. Whether the IRS has ever matched those, I don't know, but they're in and I have a certified mail receipt on them. And then there's been some discussion lately on the W-7, whether VITA can do it or can't. But, you know, it's a 1-page form with 14 pages of instructions. That should tell you it's not quite as easy as it would appear. I'll stay out of the details here unless there's a question. And I do want to note there is a moratorium on acceptance agent applications, either new ones or renewal of your contract until summer of 2023. The ITIN applications, though, on a W-7 for taxpayers are still being processed. Okay, we'll move on. Okay, the following were 1-year provisions. These may have 2022 application. One, the deferral of the self-employment payment due January 3rd, 2023. And then the 3-year spread on your corona-related withdrawals. Key there is look at the taxpayer's 2020 return, see if there was an 8915 included. Getting taxpayers to bring in last year's return is hard enough. Getting them to bring in 2020 may be a little more difficult, but I think taxpayers that are involved with this would have those available. Okay, next slide. And I go back to Brad.
Okay, y'all are stuck with me now, or at least for a little while. Thanks, Marshall. And I found myself, I know I'm not on camera, but I found myself nodding as Marshall was saying certain things. I'm going, yes, yes, he said it. Thank you, thank you. All right, child tax credit. This is always a hot button issue every year. You should know if you did taxes last year. I should tell you, we're going back to rules that are similar to what we did in 2020, not totally the same, but very close. So here's what's gone. This one, I can hear you all groaning right now. The increased age of children who are eligible for the child tax credit. Last year, you could count 17-year-olds as dependents who were eligible for the child tax credit. This year, 17-year-olds go back to getting you the credit for other dependents. They have to be 16 or under. Go ahead, you can groan. I know how many times have you had to answer that question for a taxpayer? Why don't I get the credit for my 17-year-old? I don't know. I don't make the rules. Remember last year we had the sort of two-part child tax credit. In other words, we had the early payments, the advance payments, and then we had the other half of it usually claimed on the tax return. And I did have a couple of people who opted out of the advance payments. The total amount of those credits in 2021 was $3,000 for kids ages 6 to 17 and $3,600 for kids 5 and under. And in those cases, again, usually half of that money was paid out in advance in installments, and then the other half was claimed on the tax return. So all that goes out the window. We're back to the $2,000 child tax credit, which is all claimed on the tax return. And the only difference between prior years before 21 and now, in the past, the refundable portion, which we also call the additional child tax credit, was $1,400 of that $2,000 max per child. Now it's $1,500 is refundable. It's indexed for inflation, so now it's $1,500, and it will presumably go up next year a little bit. Maybe. Who knows? Maybe they'll make the original 21 provisions permanent at some point, which was such a help to people during the coronavirus. To claim the additional child tax credit, again, that's the refundable portion. We've gone back to requiring earned income of at least $2,500, and it's a graduated amount as your income goes up a little bit. The exception is if someone has 3 or more children. And also, bona fide residents of Puerto Rico no longer have to have 3 or more children in order to claim the credit, the child tax credit. Okay, so those are the main differences, and they're pretty significant because, as you know, a lot of people, and to Marshall's point in the last block, people are going to wonder, and I had a coworker this morning, what is the deal? She asked me, what is the deal with people saying that refunds are going to be a lot lower this year? What is this? And it has to do with these changes to these credits. So I think it's important if you're a trainer to maybe have some conversation with your volunteers about how to approach those conversations and be empathetic, but be realistic that these are just changes and that it's not because we did anything incorrectly last year or this year. It's just changes in the rules and to be conversant in those changes. Now we're going to talk about the earned income credit because that's the other hot button topic people get excited about. And there are a lot of changes here and then some things that are permanent. So I'm going to talk about first what's expired. If you remember the childless workers, so people who did not have kids, the income limit at which they could receive earned income credit shot up last year. That was a one-time thing. It goes back down. So if you remember last year, it was like $21,000 and change, $27,000 and change if you were married jointly filing, and that's dropped back down close to where it was before 2021, to around 15 and change, I believe. We'll see those numbers in just a moment. But the bottom line is the amount of the credit was also higher last year. It was like $1,500 and something in 21. It's going to go back to 5 something in 22. So those changes are reverting to much more like what they were in 2020. Last year we had these cool age limits that were taken off. That were great. Like I saw more senior citizens who were shocked because they were still working part-time. They'd never gotten earned income credit before. And then they got earned income credit and they couldn't believe it. Wait, what do you mean I'm getting back X amount of money? That was a one-time thing. So we're back to the rule of earned income credit for people who do not have dependent children is restricted to ages 25 to 64. That means last year we also had a lower age, they lifted the restriction on people under 25. So people who were not students who were working in their 20s could get the earned income credit all the way down to age 19. 18-year-olds who were former foster youth or who were attested to being homeless youth could also get the earned income credit. That all goes away. We're back to 25 to 64 being the age range for childless workers. And then remember the last 2 years, we've had the ability, and it's worked out really well for some people, if their earned income in 2019 was higher than their earned income for 2020, and then they let us do it again for 2021, you could use the earned income from the 2019 return to calculate the earned income credit if it was beneficial and if the income was higher. So if the 21 income was, say, $30,000 and the 19 income was, say, $15,000, and maybe the 15 that didn't work. But if it was the other way around, if your 19 was, say, $25,000, and in 2020 or 2021 you didn't have much earned income, maybe $2,000 or whatever, you could use the 19 number. That's gone. Next slide. So those are the things that have expired. Now we're going to talk about things that did stick around and managed to make it through COVID and still be here with us. So if you have taxpayers who have socials, but their children, for whatever reason, do not have socials, they have ITINs, the taxpayer can still get, if they're otherwise income eligible, the earned income credit. They would just be eligible for the smaller earned income credit for people who don't have children that make them eligible. In other words, the kids have to have social security numbers in order to make you eligible for the earned income credit that comes with having kids. But the childless workers version, which is, of course, much smaller, you can now get if you have a social but your kids do not. And I did test it to see what would happen if one kid had a social and one kid did not. It gave it to me for the one who did. So it in the past, if everybody on the return didn't have a social, then you just didn't get any earned income credit at all. Investment income for the earned income credit. Back in the day, it was like, $3,200, $3,400 of investment income ruled you out. Now, last year it was $10,000. This year, I think it's $10,300 of investment income would still allow you to get the earned income credit. I don't see this much in my sites, but maybe you do. And apparently it will be indexed for inflation. Now, this is another one that people get confused over, so I want to go through this. This special rule for separated spouses. Okay, you can see here, if they are married, not filing a joint return, had a qualifying child who lived with them for more than half the year, and either they lived apart from the spouse for the last 6 months, or they're legally separated and didn't live together at the end of the year. This sounds an awful lot like you would think, okay, well, these people sound like they qualify for it to be head of household anyway. They lived apart the last 6 months of the year. The difference is it does not say you paid half the cost of keeping up a home. So here's a scenario when you might see this. Mark and May, let's just say, separate in April of the tax year, and May moves in, and May has a daughter, Nancy. May and Nancy move in with May's parents. May's parents are paying the cost of keeping up the home, but otherwise May would be, if she were paying for the house herself, or the cost of keeping up the home, she would probably be able to file head of household, right? Because she's been apart from Mark for the last 6 months plus of the year. She has a qualifying child dependent living with her. She's taken care of. She doesn't have half the cost of keeping up the home. Otherwise, she'd qualify. So in this case, she would be able to claim the earned income credit. This is kind of narrow because, like we say, most people who fall into that situation, at least that I've seen, probably could file as head of household and do it that way. That tells you what's permanent from the 2021 version of the earned income credit. And now I will turn it over to Marshall, who will go into adjustments and other things. And y'all, we're almost in the home stretch, I promise. I hope you're still with me. The only problem is I can't tell if you're asleep or not, but please try to stay awake with me. Marshall will keep you going. All right, Marshall, your turn.
I was so glad that Brad said he was nodding and not nodding off while I was talking. But moving on inflation adjustments, I thought I'd just cover a little bit of background here because every day, it seems like we hear the latest consumer price index numbers, and they've gone up considerably this year, although I think things are in a little better shape right now. Under the law, the IRS uses an average over the 12 monthly previous readings of chain consumer price index. So it starts in August of the prior year. So the inflation adjustments we're going to talk about for 2022 actually go back all the way to August of 20. So you'll see they might not correspond with what we're seeing right now. And one word on chain consumer price index. The consumer price index that you'll see on the news, that's dealing pretty much with a standard market basket of goods. Under chain consumer price index, they consider substitution. So if the price of chicken is better than the price of beef, they assume the consumers will buy more chicken. It results in a lower number than the consumer's price index, and it was put in back in with the Tax Cut and Jobs Act in 2017. So it's a little different than the CPI we see on TV. Standard mileage allowance, that can be a little more current because there the IRS hires a contractor to come up with a fixed and variable costs. Fixed costs would be lease payments, depreciation, insurance, things like that. Variable costs would be gasoline or fuel, repairs, things like that. The rate for medical and moving is based on the variable costs only. The rate for charitable service is set at 14 cents per mile by statute, and that was set, used to be 12 cents, but that only increases when Congress decides to increase it. And then finally, the interest rate going into this filing season will be 7%, up from 6% last quarter, but maybe more importantly, up from 3% last tax season. So late filers last season, it wasn't quite as expensive as it will be this quarter. I think we always want to remind taxpayers that in addition to penalties, which we'll talk about in a minute, there's also the interest factor. Okay, we'll move on. I just want you to be aware of these numbers. Some of you probably memorize them much better than I can. My buddy, who I talk to every year about taxes, same one that wanted the babysitter's social numbers, he always asks me, what's the new standard deduction? And I tell him, well, I don't know. and then he'll question my taxability. Probably he's right there, but this year, because of this presentation, I can tell him for certain that the new standard deduction for joint filers is $25,900, and him and his wife will each get the additional $1,400 for being 65 and over. So I think his faith in me will be restored. Standard deduction for dependents has increased a bit. And finally, the gross income limit for determining qualifying relative dependency is now $4,400. Once that person you want to claim as a qualifying relative makes $4,400 in taxable type income, you can't claim them. That's a pretty low threshold. It makes it very difficult to claim many qualifying relatives. I'm going to get on my soapbox for 1 minute here. In Michigan, and I believe Mississippi, we still have state law that prohibits cohabitation, which basically, now in Michigan, for example, it doesn't mean I can't claim my roommate. But once I start doing more than shaking hands, then I've got a problem potentially under the cohabitation law. My understanding is after years of trying, after the November election, I think we're going to get that changed this year. So I'm going to stay tuned on that. Okay, next slide. Yeah, these earned income credit changes, be aware of them. The IRS will tell you you can make up to $59,187 and get an earned income credit with 3 kids of $69.35, but at that income level, your credit, I believe, ends up being around $5, but still it's a correct statement. The investment income limit is now 10.3. Most of our VITA clients won't be affected, but you got to look at what is thrown into investment income. Okay, let's move on with that. Okay, standard mileage rate. These were changed in the middle of the year. Again, IRS has more ability to change these because they are based on a survey done by an independent contractor that they hire. So they can adjust this fairly quickly if they need to. And they have in past years changed it in the middle of the year, but now it's 62.5 cents per mile for business miles. Important to remember that employees can no longer claim this deduction because it would be a miscellaneous itemized deduction, but fine for our self-employed taxpayers. Just keep in mind the commuting rules and things like that.
And I would just point out that the TaxSlayer blog this morning indicates that the mileage entries have been updated for Schedule C. So you can now put those half-year entries into the software, as that was one of the things people have been complaining that they hadn't been able to do. So apparently that was changed this morning.
Thank you, Brad. Now this next topic is under the title of things that 4491 didn't teach you. The basis reduction amount is 26 cents per mile for the year 2022. What this is in effect depreciation. Now we know VITA can't do depreciation, so I won't use that term. I'm going to call it basis reduction. When I claim that 62.5 cents per mile for business miles driven, in that is a depreciation factor, I said it again, 26 cents per mile. And that's going to reduce the basis of your business automobile. No problem as long as the taxpayer keeps that car. As long as they keep that car, keep using it in a business, you can go all the way down to a basis of 0. And even then, you can keep claiming the 62.5. So that doesn't affect you as you own the car. Problem will come in when you trade it in or sell it. Now you've got a sale of a business asset. I mean, that's just the way it is, out of scope. So probably at that point, you need to refer them to a paid preparer. I say you should. I'm not the scope police, but we should try to follow scope. I would urge Ton and the IRS to get together someday and do a scope summit. Look at these scope provisions, see what really could be given to VITA, done by VITA. And I understand there's things that can't. Okay, that's my talk on basis reduction. Now, one other thing though on that, we can't do depreciation. We can't do section 179, but to my surprise, I found you can do a de minimis safe harbor for asset purchases. And that's over on page 9-10 of 4491. If you determine the taxpayer has an accounting policy or procedure that allows for the immediate expensing of assets up to $2,500, you can do that. So if they buy a $2,000 lawnmower for their landscaping business, you can't depreciate it or use 179, but you could look at their accounting policy. And how many of our clients have accounting policies or procedures? Don't know. But you could do a 1.263A1F election, which I think you can do online with the prepare note area and be able to claim that. But page 9-10 on pub 4491. I've said enough on that. Let's move on. Retirement saving credits, these limits have increased a bit. It's a great credit. The only concerns I have with it, these phase outs are really drop offs. Once you hit these amounts, you lose the credit entirely. And I'm thinking, well, somebody is making 34,000 at single, they can get some of the credit. But if they cash in that $5 scratch off lottery ticket, now they're at $34,005, they lose the entire credit, which isn't still available at 34. So might tend to discourage compliance. Also, a full-time employee cannot get this credit, or full-time student, I'm sorry, can't get it, even though if they're 50 years old working and paying into an IRA or a 401k, if they go back to school full-time while they're working, they can't get the credit. Anyway, those are my comments. Have I done anything about it? No, but I'm thinking I may write to my representatives. Kiddie tax. Now, kiddie tax is not in scope for most of VITA, but it is available for Alaska residents on the permanent fund and Native Americans on their per capita payments. And you have to have at least 2,300 to qualify. My concern here is that when you're looking at kiddie tax, unless you're in the groups, serving the groups that can get it, you've gone through the work on Schedule H3 and the 4012, determine they're subject to kiddie tax. Now you have to refer them to professional preparer. You've done the heavy lifting. Why not just continue it, especially if the parent is there? But that's a scope issue for another day. The elementary and secondary school teachers, that's gone up to $300. The good news here is that it is indexed for inflation, so it will continue to change. Bad news is it was first indexed in 2016, and it's taken 6 years to get a $50 increase, but it is now $300. I just want to mention failure to file. That's not in the 4491 that I'm aware of. If you don't file within 60 days, then there's a minimum penalty that applies. Now, normally failure to file penalty is 5% a month. So if you don't file within 60 days, you're into the third month, so you've got a 15% penalty. Well, let's say you owe $400. No fun for the IRS to send out a bill for $60. But with the minimum penalty, you will owe $400 as a penalty. So it can be quite steep for people that delay filing. Again, it's only if they owe tax. A refund, there's no penalty, except you got to file it within 3 years. That's pretty much on that. I do want to mention quickly first-time abatement. It's not a state secret, but many people aren't aware that if they've been compliant for 3 years, filed all their required returns, and have not had a penalty within the last 3 years, they can get the tax abated quite easily by contacting IRS. So if the penalty abated, I'm sorry. So you would call IRS when you get that notice, or go to your local low-income taxpayer clinic. I hope you have one nearby, and they can help with that. But it's something that people may not realize, and it's called first-time abate. But actually, you can do it every 3 years. So but it's a safety valve for taxpayers who otherwise are complying. Okay, move on. And just the education benefits, the limits have increased. Those are typically above VITA. I just wanted to say here that one of the requirements for the American Opportunity Credit is the felony conviction provision. I've had that happen once where I got all the way done and I said, by the way, you haven't had a felony conviction, have you? The young man said, yes, I have. I felt so bad I couldn't get him the credit. There have been bills reintroduced in Congress just in the last week or so, so they're not really going to go anywhere this term. But hopefully they will go in again next term, and I'd like maybe we can get some advocacy going. The bills would eliminate that provision from American Opportunity Credit. I think it'd be good to look at that. The long-term care premiums, I only found a decrease in one category, can't explain it, but that's what it is. And we'll move on so we can allow for questions. And the repayment caps for the advanced premium tax credit have changed just a bit. Health savings account deductions have increased a bit. I'm not going to dwell on these right now. We will get the PowerPoints out to you. And then one last slide, I believe. Okay. Poll question. I'm done with my presentation here.
Yeah, thanks, Marshall. I will take over the poll question here. Thank you, everyone, for submitting the questions. We have a quick question counter tool here on the back end, and we have well over 100 questions. So we won't be able to get to all of them, unfortunately. However, we'll have a way for you to get in contact with our presenters to get your questions answered sooner rather than later. But in the meantime, we're going to jump real quick over this poll question. We saw a lot of questions throughout the question box, but I want to hear from you now, which is really about which tax law change will have the biggest impact on your work. So please select one of the following options: changes to the tax forms, changes to the Form 1099-K. I know there was a lot of activity on that. Changes to the tax credits, changes to ITINs, or inflation adjustments. So please take a few moments to answer this poll to get a sense of, so we can get a sense of what's going to impact you the most, as well as what's going on among your peers. All right, great. 78% of folks chose changes to the tax credits, and coming in a very distant second is the Form 1099-K reporting standards. Yes, I agree. Someone mentioned in the chat the CTC changes would be a big shock for those families who got a large tax refund last year and will not be able to expect the same. We will go to a few questions. Unfortunately, we have only a little bit of time, but I would like to go over to this question here, which is around digital assets and cryptocurrency. And if a client sells transactions from Robinhood Crypto or another stock with crypto provider, and they've been buying and selling, crypto shares throughout, would this be considered a stock sale or a digital asset sale?
Because this is Brad, I'll take that one. Because the statement on the 1040 says, did you have either digital assets or a stake in digital assets, I would think that that would be considered a digital asset and therefore would be out of scope. It's unfortunate because we've seen a lot of those, right? People come in with the Robinhood especially, and also Coinbase, and they've got, and the thing is the ones I see, they're usually young people who were playing around, didn't know what they were doing, probably made 35 cents. And it's unfortunate that we were having to out of scope those folks because the rules for, I took 3 sessions, and I still don't necessarily understand it all, at the nationwide tax forums on crypto for my own personal education, just because I wanted to understand it. I still don't understand it all. I understand some of it, but it can get very complicated, and as we've seen in some cases, the reporting is terrible. Sometimes you get these things and there's no cost basis, there's no holding period, and it's a mess. And I think that's why they're coming out with the Form 1099-DA, to try to sort of stabilize that a little bit. But it is technically considered out of scope for us right now.
Great. Thanks so much, Brad. I will go over to another question, which is, have there been any changes to the eligibility criteria for folks to get help through VITA? Any big eligibility changes for VITA clients?
I don't know that I have gotten anything from my spec about the income limit. I know it's usually tied to the earned income tax credit amount, the amount of income you can have and still receive some earned income credit, which now is just over $59,000 with 3 kids. So I would suspect they're going to say $60,000. Has anyone, Marshall, did you get anything official?
I'm sure I saw the 60,000 number, but again, that's a guideline. Our IRS representatives here always say that's a recommended guideline, but programs can exceed it, and some do. But that's a recommended guideline. Your best, look on all of that is your scope section in the 4012, Pub 4012. I mean, that'll tell you what issues are in or out of scope. But in terms of overall guideline, I don't think there's any major change that I'm aware of.
Nor I.
All right, we have a few more questions that we can get to, and this one is about mileage and basis reduction. The question is, can you claim both mileage and basis reduction as business expenses? And also, where would you enter business reduction of a vehicle?
Okay, this is Marshall. I obviously didn't do a good job on that slide, so let's go back. You're claiming the standard mileage allowance. That's fine. That's nothing different there. The only thing that I brought in was basis reduction. It's not something you claim on the return. All it does, it's a number that as you use that car for business, it reduces your basis. And where that comes into play is only when you sell or exchange that car. At that point, you have a sale of a business asset, because no longer you can do like-kind exchange on a personal property like a car. It only comes into play when you get rid of the car. Then you've got a sale of a business asset, which gets you out of scope. But as you use the car, that basis reduction doesn't show up anywhere, except when you plan to get rid of the car. Then you've got to take it into account when you determine your basis in the car for sale purposes. Maybe I should have not got into that, but that's the basics on it. That's all I had. Brad, you want to add anything?
I'm good on that. You exceeded my abilities on that one, Marshall.
All right, I think for our last question, it's really more of a question for clarification on the kiddie tax, especially because it's drifted in and out of scope for the past few years. if we could get another breakdown of what the kiddie tax is and what it entails.
Well, basically, it'll tax the young person at the parent's rate on unearned income above the $2,300. And I don't want to spend a lot of time getting into the details of it, but if you go to publication 4012, I believe it's page H3, that will, I can check that, but that'll take you through H6. Well, maybe H3, let me, 4012 will give you a good worksheet that takes you through the eligibility, but the calculation basically is they'll pay tax at the parent's rate on some of their earned income.
And it's a little fuzzy because, you know, when you're trying to figure out if kiddie tax comes into play, I'm going to try and get this right. So scholarships are considered unearned income, which can trigger this for that purpose, but they are considered earned income when determining whether the person has to file a tax return. So it's a little convoluted. And again, we can probably refer you to some easier to follow documentation on that. But where it gets tricky, and having helped a friend of mine outside of the program with that stuff, where it gets messy is you have to know the parent's income and information about the parent's return in order to do it. And it can be pretty shocking when you do it and you see just how much they're going to tax this kid who has nothing because it's based on his parents' tax rate.
Yeah, Brad, that's great. It's H3 of 4012 gives you, it will tell you whether it applies when you work through the scenario there. But I would add, the tough one is when the parent is there, you're doing the parent's return as well as the child. And then you have to tell the young person, sorry, we realize you're subject to it. We determine you're subject to it, and we have to send you away, even though we have the parents sitting right there and we know their rate. But that's a scope issue.
I don't disagree. I don't disagree with that.
That's my editorial comment there.
Yeah, I don't disagree with you, though. It is frustrating because we want to help everybody. That's just how we are. And you feel like you have the tools at this point. We've got the parents' return. We got the kids' return. It is frustrating. But the reason it was in scope for a little while is because for a while it was based on what's called the trust rate. And at that point, you don't need the parents' return. And so I think so for a hot minute, it was in scope, but apparently they figured out that when you use the trust rate, you really sock it to them. And so they switched it back to being the parent's tax rate, and it went back out of scope again. So that's why it's kind of come in and out. That and there are lots of things like Marshall was talking about, the mortgage insurance premiums. I call those hokey pokey provisions because you put them in, you take them out, and you put them in, you shake them all about, right? And that's kind of one of those things. It comes and goes.
That is a great image to end our conversation. Again, everyone, thank you so much for your questions, your comments. It is blowing up here on the questions box. So what we'll do is we'll also leave you with this screen. So if you go to your GoToWebinar panel, you should have the ability to screenshot this presentation slide in this particular screen. If you want to get directly in contact with both Brad or Marshall, to answer your question directly. If you aren't able to screenshot or don't know where you put it, don't worry. We'll be releasing the slides to you along with the recording, so you can go and access the slides directly as well as the presenter contact information. We are excited to have all this interest and answer any questions you can have. And we will try our best to distribute any big question and answer themes that we see. We'll come back with Marshall and Brad to just chat those over and share any clarifying points or big takeaways. In the meantime, we're going to move on to the next slide, which is just a way to stay in touch. Brad and Marshall are two great members of our Tax Roundtable listserv community. If you want to join our listserv and join your fellow ton members in close conversation about the finer ins and outs of tax prep, please do join the Tax Roundtable listserv. The link is in the chat, or it's on screen, which is taxroundtable.groups.io. In addition, you can always join Ton to find out more and get our monthly newsletter. Regardless, if you have any questions, future learning suggestions, and other feedback, please feel free to email us at taxpayeropportunity@prosperitynow.org. Again, thank you so much for joining. Thank you, Brad. Thank you, Marshall, for being part of this extremely in-depth and thorough conversation. We will close our conversation here, but please complete our surveys, which will pop up on your screen as we end the conversation. So again, thank you so much for joining, and I hope you have a wonderful day.